We're going to talk today about your investors. And I have this conversation frequently with clients about who the investors are, what their wealth situation is, how they know my clients, and those types of things probably sound just kind of like context, like sort of peripheral to the details of what they're going to write on that check and when they're going to write that check. But those details are actually tremendously important. And the reason for that goes back to securities laws. So securities regulations, the SEC, the Securities Exchange Commission, they are going to govern any interaction, transaction where someone writes a check to your business for you to then run your business and then give money back to that person that wrote the check. No matter how small you are, no matter if you don't even have a business entity and you're just a person and they're writing a check to you, the securities laws will cover all of those scenarios. So it's really important to make sure that you know everything that you can about your investor so that you can make sure that based on that investor, you follow the right compliance under the SEC. So what am I talking about here with regard to these investors? Well, again, I want to stress that depending on the status of your investor that we'll talk about in this video, every type of compliance, both at the state and the federal level, is going to be related to the status of those investors. So you hear all the time, friends and family rounds, or seed rounds, or Series A. Those are all categories of fundraising, investment rounds, and they tend to have their own connotations. So a friends and family round is going to be just what it sounds like, raising money from your friends and family through various different ways. Then there's going to be a seed round, which will be sort of like a bridge round where you do some investment maybe from some wealthy people that you know or some friends that didn't fall into the friends and family round. And then a Series A is usually going to be a little bit more formal, more like a venture capitalist or an angel investor, and sort of bigger numbers and bigger compliance. But let's go back. We'll talk about friends and family. Now, when you do a friends and family investment round, a lot of the time your friends and your family sort of fall through these exemptions in securities law because they know you well and they can trust that you're going to manage the business in the way that you say you will because of their long-standing relationship with you. And so what you look for in those situations is trying to find, you're always looking for an exemption from securities law when you're a small private company in order to avoid really lengthy and costly compliance and filings and things that go along with larger companies and like public offerings. So going back to the friends and family tend to fall into an exemption because of the relationship that you've had with them, how long they've known you. They're sort of privy to your ability to run your business. And this is all going to be an oversimplification. Remember, I'm doing high-level education in these videos. But friends and family rounds, typically easier to find an exemption for those friends and family so you don't have to do a bunch of compliance. And compliance, when I say that, usually that means giving them lots of disclosures and financials and information and sometimes a prospectus or a private placement memorandum. A lot of things that you have to do that are costly to pay professionals to do to give to your investors, but your friends, your family, they know you, they need less of that, so it's a little bit easier, and they usually fall into an exemption. Sometimes where they live, where your business is, sometimes that makes a difference. So again, oversimplification here, but friends and family tends to be a little bit easier to do. Now, when we go to, let's say, maybe a seed round, and these aren't friends or family, maybe they're introduced to you through business contacts, whatever the case may be. These folks, if you're looking at them not through the friends and family lens, then you have to determine, are they accredited? Are they accredited and sophisticated? Are they sophisticated and not accredited? These are some of the words that are very important for looking at your investors because, again, you're looking for an exemption. And if they're accredited and sophisticated, that's the best. Sophisticated means they're savvy in business matters, they've invested before, they have lots of investments, and accredited typically deals with their own personal wealth. Sometimes the numbers you'll look at are whether they make more than $200,000 a year, year over year. Do they have $1 million net worth, not including their primary residence? These are some of the factors that go into this. They're not the only factors. Definitely more involved analysis than what I'm laying out here, but those are the general framework for what an accredited and sophisticated investor is. And if you have an accredited and sophisticated or a sophisticated, there's usually going to be exemptions for those categories of investors. Now, what are the other categories that I'm not covering here? Well, an unaccredited or an unsophisticated investor, someone not used to investing, they do not have the personal wealth that the law deems necessary for investment to be accredited. These are people that the law views to be at significant risk if they invest in your business because they don't know what they're doing, because they're not sophisticated, or they don't have enough money to absorb the loss if the investment doesn't go well. And so because of that, they don't fall in an exemption, and you have to give them lots of paperwork. Sometimes a private placement memorandum, which talks about marketplace factors, competitors, risks, liabilities. You might need to give them your financials, all of them for many years, your projections, all of these different things that go into giving them the information that they need to make sure that they are making a smart decision, given that they don't have a lot of money and they aren't necessarily very savvy. So, really important to always be making sure that you don't have these unaccredited or unsophisticated investors unless they're friends and family. Now, let's move on to, VCs, angel investors. They're almost always going to be accredited and sophisticated, and because of that, you can do much, much, much less paperwork for them. They know what they're doing. They have expectations of what it's going to look like. They may even have template paperwork that they're going to give you through their legal team because they do this in their sleep. It's just what they do. They invest. So let's kind of rehash that, break it back down really clearly and really succinctly. Investors, who they are, how much money they have, how they know you, actually dictates what type of paperwork, how much paperwork, and how expensive it is going to be to do an investment round in your business. So, laymen, just unsophisticated, unaccredited folks, they are going to be very expensive to do investment because the risk is very high unless they are your friends and family and they've known you for a very long time, and there's a few other factors present that allow them to fit neatly into a friends and family exemption. Otherwise, those unaccredited, unsophisticated folks require lots of paperwork, gets very expensive. Now, you can have accredited and sophisticated folks, usually seasoned investors or VCs or angel investors. Those are the people that you can do a very minimal amount of paperwork because they do this all the time, they've seen this before, they know the drill, and they can absorb the loss because they're wealthy if something goes wrong. And those are the types of investors that you need to be mindful of. And all of this really is meant to illustrate if someone comes to you and wants to invest and they're already writing the check and you already shook their hand, don't do that. That's not enough. The handshake deal is a disaster waiting to happen because if later on that person's pissed about how the investment didn't go well and who knows what their situation is, you could find yourself in very hot water. Frankly, the hot water could even include jail time, huge penalties. Securities law is very regulated, very strict. And we haven't even talked about something called the anti-fraud statutes, which quickly, I cover this in another video, but quickly, anti-fraud means do not put misleading information in anything that you give to any of your investors because you will have committed fraud by lying to them, even if it was inadvertent. So, we talked about the types of investors in this video. Check out my other securities videos. I have a whole series of securities information to help you all navigate investment in business so that you can get out there, make a badass business, and grow it. Next stop, the moon, right? Hope this was helpful. Thanks for tuning in. See you again soon.